Okay, so pretty much right now what we're going to do is we're actually going to be inviting the people on YouTube. So this part of the webinar is actually going to be available for free for people on YouTube. But the questions are only going to come from the people who are in the webinar. So you guys that paid for the webinar, you guys are going to be the only ones that are able to ask the questions. But again, everyone who is listening, because we're streaming right now on YouTube, they can actually partake. So I think we're live right now. So again, thank you again for those of you guys who paid for the webinar. If you guys would like to join the webinar in the future, let me know, comment below. But right now, this is actually going to be the free portion of the webinar where we are inviting pretty much anyone to join in. This is going to give you the fundamentals, and we're going to have a question and answer session. The question and answer session will only be with the people in the webinar, but we're going to go ahead and get started right now. So you are watching Carlos Speaks Wall Street, and we are going over understanding Forex. And again, this is just a small piece of a larger piece. We're just doing something that's, real simple and easy to use or easy to understand for you guys on YouTube. So with that being said, let's go ahead and get started. We're going to go ahead and switch over and begin.
With options, your entire strategy is based on what you... I'm going to give you the fixed protocol. Options Greeks. And today's topic of discussion is... Not exactly, not quite, not that kind of effects. We're not talking about spacecraft and lightning bolts and fire and flames. Michael Bay, gotta love Michael Bay. By the way, if you haven't seen that new movie, Edge of Tomorrow, check it out, awesome movie. With options, your entire strategy is based. So in this video, I'm going to teach you everything you need to know about FX or Forex. This is your FX primer. And here on this channel, we keep it easy, fun, and fast. Might bring a smile to your face, actually enjoy the learning process, and yet you're able to understand something that was previously complex, now seems simple. Let's talk about FX, maybe. Let's talk about you and me. Let's talk about all the good things and all the bad things, like leverage. Well, we'll talk about leverage. That's a double-edged sword. It's both a positive, it's a blessing, and a curse. Stay tuned to find out why. Promise not to sing anymore in this video? Well, I can't promise that. Forex. So let's go ahead and F-O-R-E-X. And then also known as FX, Foxtrot X-ray. So what is FX all about? I'm going to surprise you right now. I'm going to let you know that you are actually probably already an FX trader, because if you've ever gone to the bank to trade your currency, let's say you're going to Italy, very beautiful country, highly recommend it. You're going to go to Italy, you want to change your US dollars. If you're coming from America, you want to change US dollars to euros to go to Italy. Well, guess what? You're basically kind of in a way participating in the FX market. I mean, what you're doing is essentially the core of what happens in the FX market. So the FX market is basically you're trading currencies. So with equities, you trade companies. Now, I know this is oversimplified. I'm trying to make this in a format where everyone can understand. So basically, I'm trying to focus on concepts here. So you think about equities as you're trading companies. You get shares of ownership in a company. In FX, it's like you trade countries. So what does that mean? The health of a company affects the stock price in equities market. The health of a country's economy affects the value of its currency, and therefore that's going to affect your exchange rates, and that's going to affect your FX trading. But essentially, again, with FX, you're trading currencies. So typically, when you look at a quote, when you look at an FX quote, you're going to see two currencies, because with trading of currencies, obviously you're going from one currency to the next. You change your US dollars to euros, so there's euro on one side and there's US dollars on the other side. So let's look at a currency pair right now. So let's say we wanted to trade we want to get euros. So here is the symbol, and this is how things are written in FX. This is a symbology. So EUR representing euros, and then you put a slash like this, and on this side you put US dollars. So this is fundamental to your understanding of what FX is all about, is to understand the way that it is looked at in terms of pairs. So this is what's called a currency pair. Now, the way you interpret this is essentially what you want here is you want euros. And this is what you have. So whenever you see this format, this is the target currency, and this is essentially what you have to convert. So I have US dollars, I want to get euros. So always look at it that way. So, and the proper terms is this is actually your counter currency, and this is your base currency. So how many US dollars will it take to get my target currency? I want 100 euros. So I have to pay a certain amount of US dollars to get that euro amount. So that's the way it looks. So when you look at quotes and you see something like $1.38, for example, being a quote, that means it's going to be $1.38 US dollars to get 1 euro. And that essentially is the basis for the FX market in terms of the way you look at things. Now, before we get into more details, I want to break down some of what the FX market is all about. So what are the details in the FX market, especially in contrast to the equities market? So let's go ahead. I'm going to put some notes on this board, and then we're going to go through them one by one. I know exactly what you're thinking. I'm a mind reader. You're looking at this and you're saying, that looks like an eye, that looks like an open mouth, and that looks like some kind of teardrop. But you're wrong. This is actually my best representation of a globe representing the Earth, planet Earth, because Forex is international. You're trading currencies all over the world. Aussie dollars, Canadian dollars, Mexican dollars, yen, US dollars, euros, you name it. But let's go through the basics here. So first of all, where can you trade FX? So FX, unlike with equities, it's one market. You don't have New York Stock Exchange, NASDAQ, and all this kind of stuff. It's just one market. And that also means that instead of looking at, let's say, New York Stock Exchange, 2,800 stocks listed on that exchange, here you're mostly looking at what we call majors. The majors are the major currency pairs. Remember, FX is all about currency pairs because it's all about exchanges, right? You're exchanging from one currency to another. So in order to have something to trade, you need two currencies. And the main ones are from the main economies around the world. So you have those main pairs, which are called the majors. And we'll go over those majors in a little bit. So the next thing is, when can you trade? You can trade 24 hours a day, 5 days a week. So you want to neglect your family and your kids. You want to be trading FX at 3 a.m. in the morning? Go right ahead. Trade all day, trade all night. No problem. And one of the reasons why you can do that, I'm actually going to skip here, is because you have an extremely high amount of liquidity. The liquidity in the FX market is tremendous compared to that of the equities market. So in comparison, let's say potentially 5 trillion, 5 with a T, 5 trillion a day in the FX market compared to a little tiny little bit, let's say 4 billion with the equities market. 4 billion shares a day with the equities market potentially compared to the 5 trillion. And just to give you a little perspective here, and we're going to jump to size. What's the difference in the size of the FX market to the equities market? Well, let's just say that this represents the entire equities market. Are you ready for this? If that's the entire equities market, then this is the FX market. Wrong. That would be incorrect. If this dot represents the equities market, then this circle is too small to represent the FX market. The FX market is about 600 times that of the equities market. So this circle would have to be much larger. Or another way to look at it is this dot here is 3 times too big. To put this in scale, to put this in an accurate scale, this dot is actually 3 times bigger than it needs to be. And the way I can determine that is because I know that on this board, I can only draw about 220 dots. In order for me to properly do this to scale, I would need to draw 600 dots. So that tells me right there that this dot is way too big to represent the scale. Another way to look at it, just to give you a little something so you can understand the scale of what we're talking about here, is if this is your loudmouth 3-year-old, let me give him a head instead of a dot for a head. That's better. There you go. If that's your 3-year-old representing the equities market, then this tall building represents the New World Trade Center, which is built to a height of 1,776 feet. So if this was the equities market, then this is the FX market in comparison as far as scale. Now, obviously, this 3-year-old is actually a giant. That's actually not a good representation if you're talking about scale. You'd have to be much smaller. But the point is, you know the difference between a 3-year-old child and the World Trade Center, so you can understand the scale between the two markets. So now let's talk about costs. The cost of the FX market is much lower than that of equities. Equities, you have these huge commissions and all this kind of stuff. You don't pay as much when you're trading FX, so it's much cheaper than equities. As far as risks, well, your biggest risk with FX is potentially going to be the leverage, the blessing and the curse of FX. You can command a tremendous amount of leverage in the FX market. Now, let's say in the equities market, maybe you have like a 50% margin account set up where, you can actually put in, let's say you put in $500 and you actually have $1,000 of buying power. If that's the case in equities, then here with the FX market, you could look at something like 100 to 1. Up to 100 to 1. Now, it depends on which institution you're trading with and some other factors, but leverage can be that high, 100 to 1. That means you can multiply your money tremendously. In terms of buying power, we're not talking about actual cash in your account, but in terms of actual buying power, which is the money that you're able to trade with within certain limitations. You may have a minimum margin requirement. So, for example, let's say on $1,000 cash in your account, based on your margin requirements, maybe you have to maintain a minimum of $200 balance on your account. So that's just for example. That $1,000 could be translated to $10,000 in actual buying power, where you can actually trade, and not 10,000, but you still have that limitation of that minimum margin requirement. So let's just say you can trade up to $10,000 minus that $200. Now, don't take these literally. I just want you to understand the concepts, get the basic idea of how this works. The basic concepts are there. For the details, we'll need to get a little bit more advanced than this particular video is. But that is one of the big advantages with FX is you have huge amounts of leverage, and you need it because unlike with equities where you have these massive fluctuations in prices, the movements here are very, very small. In fact, the movements here are actually, the way we look at movement here is in pips, which is percentage in point. So with the percentage in point, depending on the currency pair, you're looking at a fourth decimal place movement, for example. So let's say we have like $1.38.6 and then 2 representing the pip. So when this goes up to 3, goes up to 4, goes down to 1, goes down to 0, that would be your pip movement depending on the currency that you're actually referring to. So when you're looking at price movements in the FX market, you're looking at very, very small and subtle changes. Therefore, you actually need to command a high level of buying power. You need to be trading a huge amount of currencies to actually make something profitable. Unlike, again, with equities where you could have a massive fluctuation in price, where you can make a lot of money real quick with not that much of investment, depending on the stock and the stock price, of course. But with FX, generally, you're looking at very, very small movements. So therefore, you want to have a lot of shares, or not shares, you want to have a lot of currency. You want to trade a lot of money or currency in order to make any kind of sizable profits. So that's something to consider. The other thing is we talked about the size of the market. We talked about the liquidity. Liquidity is very high. You can trade anytime you want to. There's always liquidity. There's always pretty much you can buy, sell anytime you want to, and those are the basics pretty much of the FX market. So we're going to go into a little bit more details in part 2 of this video, but I think pretty much we've covered all the basics, all the things that you need to know about FX. But you're probably wondering things like, how do I trade currencies that I don't own? Like, I have US dollars in my account and I want to trade a currency that doesn't have a currency pair that doesn't have any US dollars in it. How does that work exactly? You can find out that in part 2 of this video. This video is just, again, a primer, an introduction into the market, so you can understand exactly what FX is and the lingo doesn't confuse you anymore.
So that concludes part 1 of the understanding of the foreign exchange here on Carlisle Speaks Wall Street. Those of you that are new to the channel, go ahead and click on that subscribe button for more content like this, and make sure you click on the bell icon to get notified when I upload new videos. We're going to get started in part 2 of the foreign exchange webinar, which we're now broadcasting free on YouTube as well as through the webinar. And again, thank you to the students that actually paid for the webinar. I really appreciate the support. And without further ado, we're going to go ahead and get started with part 2. That rhymes. Without further ado, we're going to start with part 2. Okay, guys, this is Carlisle Speaks Wall Street. Buongiorno!
With options, your entire strategy is based on what you... I'm going to give you the fixed protocol. Options Greeks.
Local currency, for example, I'll give you an example here. Let's look at... By the way, these currency pairs actually have nicknames. So what we're going to look at right now is I'm going to look at what we call guppy. So a guppy would be, let's see, GBP against the yen, Japanese yen, so JPY. So you have an account that's funded with US dollars. Let's say you have $1 million, $1 million US. So how can you buy or sell a cross pair? So this cross pair features currency that you do not have. This is what you need to know. Basically, when you're trading FX, you're trading Forex, a lot of this stuff happens in the background. So you don't have to really concern yourself with that kind of stuff. All you're really doing is you're making decisions based on news, based on markets, technical analysis, whatever it is, and you're doing buy and sell. Now, in the background, however, a lot of stuff is going on. So basically, what's going to happen is essentially that kind of transaction, a US dollar funded account trading foreign currencies, essentially in the back end, they're going to be doing math. So look at it that way. In the back end, they're doing math. Don't think of it as a literal thing where there's one guy with yen and you're going to change US dollars to yen and then to... Don't think about it that way. Just think about it as mathematical formulas. So if you've got US dollars in your account and you want to trade this currency pair, then they're going to do a double conversion. They're going to convert from the US currency amount to whatever the amount of yen is that you want to trade to go over to the pounds. So that's what basically happens. So there's one conversion from US dollars to yen, another conversion from yen to pounds, and then your account balance is going to reflect based on those calculations. So now, hopefully, if you're right and the pound value goes up, then when you convert back to yen, it's going to convert that value back to the US dollars, and the amount should be greater than what you started with because you're going to get more yen than what you started with. And then when you convert the yen back to US dollars, you end up basically profiting. So that's basically the way it works. So again, you don't have to worry about that stuff. That stuff happens in the background, so you don't have to really think about it. But essentially, again, they're going to convert from US dollars mathematically to yen, and then from yen to pounds, and then you're going to hold that position, which is called you're going long. Whenever you're buying, you're going long. Whenever you're selling, you're going short. So you can hold this position, and then you're going to wait for the price basically to move in your favor. You got to first get beyond the spread, of course, because again, there's a difference between the price of the buy and the sell. So once you've crossed the spread, and now you're starting...
I apologize. We have sort of jumped the gun here, so we need to back it up a little bit. I apologize. Acosta DC joining us here. July 6th, and we're going to be backing it up. We kind of jumped the gun there. I apologize for that. Technical difficulties. This is Carlisle Speaks Wall Street, and we're backing it up. Rewind selector.
We're not talking about spacecraft and lightning bolts and fire and flames.
With options, your entire strategy is based.
Welcome back. I'm glad I didn't scare you away with part one of this video and you're eager to learn more about the FX market or Forex market. So in part two, we're going to go into a little bit more detail. We're going to touch on a little bit of the accounting side of things. We're going to talk about how you actually trade FX. Now you understand the fundamentals. If you watched part one, if you haven't watched part one, go watch it now. Thank you. Anyway, so now we're going to learn a little more details about how this all works. So just a quick review of the last video. We talked about the Forex market. So Forex market, basically you have a single market, unlike equities where you have all these tons of, New York Stock Exchange, NASDAQ, whatever. You have a single market. You can trade 24 hours a day, 5 days a week. So you can trade 3 a.m. in the morning, whatever. You have high liquidity, which it also allows you to do that. You can pretty much, the volume is always there. 5 trillion shares a day potential. You have a much lower cost than equities. You have a higher risk potential with an advantage of high leverage. So you have high leverage up to 101, but that also it's a blessing and also a curse potentially. You can make a lot of money using high leverage, but you can also lose a lot of money using high leverage. So you also have, again, we talked about 5 trillion versus, let's say, 4 billion shares a day with equities potentially compared to the 5+ trillion with FX. So those are the basics that we talked about in part one. Now let's look at trading FX. Let's look at that in detail. I'm gonna actually draw an illustration of what you might see on a trading platform. Like FXCM is a company that actually has a trading platform called Trading Station, and I'm gonna basically illustrate what you will see in that system, and this is something you're going to see in other similar systems as well, just to get you an idea, get a little bit more detail about how this all works, the actual nitty-gritty. You understand the fundamentals, but now let's get onto the surface. Let's get into some more details of trading FX or Forex. Let's talk about FX, maybe. Let's talk about you and me. Let's talk about all the good things and all the bad. I'm showing my age right now so much. Anyway, let's draw something that you might see in your GUI or your trading platform. So here in this box, let's put, the fundamental thing is you're going to need quotes, right? How are you going to trade without quotes? You need quotes, man. So you might see something like this. So you have this box here, and on one side, you might see like 95, and this side you might see 93. And then on top, you have the currency pair in question. So there you have euro, US dollars, and then you have price information. So let's.
Everyone that's listening in live, go ahead and click on that like button. I really appreciate it. It's not for me, it's for YouTube. YouTube needs to know if you enjoy the content. If you don't let YouTube know that, then the video doesn't get any views, and we all get penalized. So please bear with us. We gotta follow the rules of the YouTube platform, and they really look for you guys to rate the videos and be engaged with the videos so they can know what content is good and what content is not good. So if you're enjoying the content, just go ahead and click on the like button so YouTube can be happy. All right, we shall continue. Pardon my interruption to you guys in the webinar and you guys listening for free on YouTube.
Let's complete this price information. So you might see here in small print 1.35. On this side you have 1.35 as well. And then you'll have your pip. Let's say it's 6, let's say this is 3. And this will be moving up and down, depending on market movement. Some kind of indicator will let you know whether it's moving up or down, some kind of arrow, triangle, or whatever. And then you're also concerned with the spread. So the spread is basically the difference between the buy and the sell, because just like with equities, if you have any equities experience, then you are familiar with this. You can take a look at my videos as well. I go over in some of my other videos. I talk about order types and equities trading and stuff like that. But there's always going to be a spread. So the spread, again, is different between the bid and the ask. So this is, on this side, this is going to be the bid. This is going to be the ask. Difference between the two is going to be your spread. And that is how the bank is going to make their profit. So if you're working with a company like FXCM, or there's also a company called, Trade King also has a Forex division. That's how they make their money, is the difference between the spread, which is between the bid and the ask. Additional information that you might see on this platform is you might see, it depends on whatever you're using, but you might see an indication of a low and a high, just like you would with equities. So you have a low and a high of the day. So maybe the high of the day is, say it went up to $2 or something, and the low of the day might be 1.1 or something. So you have an idea of the range. Now with the FXCM trading system, you also have access to charts. So you can have kind of a pop-up thing here that shows up on the side, and that's going to show you all the price movements and things like that. And then you're gonna see it's gonna have like actual little blocks like this that are gonna actually indicate the current quotes. All right, so you can actually kind of figure out what's going on. Like you can see this on the day, this price looks very low. So I got to decide, is it going to continue going lower? Is it going to stabilize? Is it going to go back up? It started high, maybe it's going to recover. You got to decide on that kind of stuff. And also you have the ability to enter like market orders and limit orders. With a market order, or limit order rather, you're going to be able to actually click and drag to set the price. So when you're going to buy something, you're going to buy based on a price that you enter if you're entering a limit order. Now you can actually click on that box, and there's going to be a little line that's going to show up, and you can click and drag it, and as you drag it up and down the price scale, you're going to see the price change. So that's, instead of entering manually a limit price, you can enter it that way. And of course, you'll see on this range, it'll be like, say $2 here, $3. It wouldn't really go that high, but just to give an example. So you have some kind of a scale, say 0.8 or something, whatever. So that's the basics of what you're going to see in a trading system. Now, additionally, you might have interest rate information. You might have like buy interest rate, sell interest rate as well. This is fundamentally what you're going to see in your trading platform, your FX or Forex trading platform. Now, generally speaking, the way you think is, if I'm buying this currency pair right now, I'm trying to buy euros. So I have confidence in euros. I think the economy is doing great. I think the price is going to go up. You're going to be able to get more euros for your US dollars in the future. So I come in with, right now the rate is 1.38. So I pay 1.35 US dollars right now for, let's put that here. So I pay $1.35 for 1 euro. That's how much I spent, because I think that the euro is going to go up. So let's talk about how an FX trade works and how you should think about FX trading. So obviously, like we said, it's all about currency pairs. So for example, hopefully you guys can see this. So we have, let's say, euro, our favorite major. In another video, I'll go over what the majors are. Majors being the most popular currency pairs out there, like euro, US dollar. So here we have euro, US dollars. Again, this is a counter currency, and this is your base currency. So the base currency is euro, and I like to think of it as a target currency in terms of, this is what I'm targeting. That's what my focus is on. If I buy, then that's because I think this base currency, it's going to strengthen against the US dollars. So this is the way it's going to work. So you start off with US dollars, you pay a certain amount. So let's say you're quoted here $1.35. That means it's going to take you $1.35 to get 1 euro. So you start with US dollars, you spend this $1.35, it converts to a single euro, and then the idea is that the exchange rate moves in your favor. So let's say the exchange rate goes up to 1.8. So now 1.8 US dollars is equivalent to 1 euro. So remember, you spent $1.35 US dollars to get 1 euro. Now the amount of euros you have will never change. You only got 1 euro, it's always going to be that, but the value of the euro against the US dollar, that will change. So if the price goes up to 1.8, that means that when I exchange my euros back to US dollars, I'm now going to end up with 1.8 US dollars. Now, again, this is an oversimplified. We're not getting into all the details of the accounting. Commissions are very low, but they are commissions. The banks are going to be making money on the spread, basically the difference between the bid and the ask. There's other factors involved, but this is the basic concept of how it works. You're jumping from currency to currency. I go to US to Euro. I think Euro is going to go up. And when it goes up, then I can close my position by selling. And therefore, when I sell, I'm actually going to get more US dollars than when I started with. That's the plan anyway. But of course, it can go the opposite way. Let's say that the euros goes down against the dollar, so now it's 1.1. So now if I exchange now, I'm going to change my 1 euro into $1.1, which would suck because initially started with $1.3 and now we're down to 1.1. And you're probably wondering about accounting wise, like how do I sell a currency I don't have? And first of all, before we get into that, let's define a cross pair. So a cross pair would be like, let's get rid of this. A cross pair is a pair which is not in your local currency. For example, I'll give you an example here. Let's look at, by the way, these currency pairs actually have nicknames. So what we're going to look at right now is I'm going to look at what we call guppy. So guppy would be, let's see, GBP against the yen, Japanese yen, so JPY. So you have an account that's funded with US dollars. Let's say you have $1 million, $1 million US. So how can you buy or sell a cross pair? So this cross pair features currency that you do not have. This is what you need to know. Basically, when you're trading FX, you're trading Forex, a lot of the stuff happens in the background. So you don't have to really concern yourself with that kind of stuff. All you're really doing is you're making decisions based on news, based on markets, technical analysis, whatever it is, and you're doing buy and sell. Now in the background, however, a lot of stuff is going on. So basically what's going to happen is essentially that kind of transaction, a US dollar funded account trading foreign currencies, essentially in the back end, they're going to be doing math. So look at it that way. In the back end, they're doing math. Don't think of it as a literal thing where there's one guy with yen and you're going to change US dollars to yen and then don't think about it that way. Just think about it as mathematical formulas. So if you've got US dollars in your account and you want to trade this currency pair, then they're going to do a double conversion. They're going to convert from the US currency amount to whatever the amount of yen is that you want to trade to go over to the pounds. So that's what basically happens. So there's one conversion from US dollars to yen, another conversion from yen to pounds, and then your account balance is going to reflect based on those calculations. So now hopefully if you're right and the pound value goes up, then when you convert back to yen, it's going to convert that value back to the US dollars, and the amount should be greater than what you started with because you're going to get more yen than what you started with. And then when you convert the yen back to US dollars, you end up basically profiting. So that's basically the way it works. So again, you don't have to worry about that stuff. That stuff happens in the background, so you don't have to really think about it. But essentially, again, they're going to convert from US dollars mathematically to yen, and then from yen to pounds, and then you're going to hold that position, which is called you're going long. Whenever you're buying, you're going long. Whenever you're selling, you're going short. So you can hold this position, and then you're going to wait for the price basically to move in your favor. You got to first get beyond the spread, of course, because again, there's a difference between the price of the buy and the sell. So once you've crossed the spread, and now you're starting to get to a point where you're actually able to sell for higher than you bought it for, then you go ahead and you close your position. You're going to sell this. Goes back to yen, and then the yen is converted back to US dollars. And again, you're not actually trading all these currencies. It's all mathematics. All you're concerned with is making your buy and sell decisions, setting your limits or whatever it is, your stop orders, and in the end, you're concerned with your account balance. If you trade effectively and you made the right decisions, then your account balance should be rising and rising and rising, and you are an awesome trader. But otherwise, all the conversions and mathematics and stuff like that, you don't really have to worry about because, again, that's all done in the background. That's all I want to cover in this particular video. This is really just a primer, part 2 of my primer, my FX primer. Just get getting you to understand what FX is all about, Forex is all about, so you can relax and stop being all scared of FX. It's too complicated. I don't know about currency pairs and all this math, and it's no, just relax, breathe, count to 10. It's not really that complicated.
This is July 6, 2017. You are watching Carlisle Speaks Wall Street, and across the globe, buongiorno, buona notte, buenas noches. So we're going to have question and answers right now. The questions will be coming in only from the people who paid for the webinar, not from the people watching free on YouTube, although you're free to post your questions in the comment section. And I guess the first, maybe the first 10 questions or so, if you get a lot of likes for your question, that means a lot of people want to know that, then I can look at those. But I'm going to limit the questions to mainly the people who signed up for the webinar. Now, I want to show you a little something for those of you that are new to the channel. I am going to show you a little something. Just bear with me one moment. So there's been some problems with people who have been complaining about not receiving notifications when I post videos. So I'm going to show you what the solution is for that. It's an issue with YouTube. So basically what you're going to do is, if you look here on the center display, if you are subscribed, which you should be if you have any sense, but anyway, if you're subscribed, you're going to see subscribed, right? So like I click on this right now, well, it's not going to allow me to subscribe to myself. So let me change to another channel. Let's see if we can change that up. And I will show you what I am talking about. What is he talking about? So if you click on the subscribe button, it'll say subscribed. Let me zoom that in. Now, many of you have done this already, but you're not getting notifications. The reason why that is because you have to also click on the bell icon and then click on send me notifications. Otherwise, you're not going to get notified when I upload new videos. And now let's move over to the question and answer section. I'm going to get my ugly mug on the camera so we can go ahead and move on to answering your questions. Feel free to ask me about anything regarding foreign exchange, and I will do my best to answer your questions. If I am not able to answer your question, then I will have to get back to you, but I will certainly do my best. So I see we have some people in the webinar are ready with their questions. Okay, so we're gonna go ahead and answer some of these questions. So I see here the first question is asking about, looks like, what is a pip? What is a pip? That is a very good question. So pip stands for percentage in point. Percentage in point. Okay, so it's the smallest increment of trade in foreign exchange. That's the smallest increment. Now, prices are quoted to the 4th decimal point. Okay, so say you're going to buy an awesome FX t-shirt, or actually in the description, there's a link to one of the top foreign exchange books out there. It's a great book and I have a great price on it. Click the link in the description to go ahead and buy that book so you can really learn about foreign exchange. Try to learn from as many sources as possible. This video is a great help to you, I'm sure. I got a lot of great feedback. There's online courses, but there's also the book, which you can read while you're doing your commute or whatever. But anyway, let's say you were going to buy that book. And let's say the book is selling for $15, which would be a great price. I don't know what the current price is. I think there's a deal on it right now. But let's say it's $15. So it would be 15.0. Now, let's say you buy that book because you enjoy the content and you want to show your support for the channel. Well, in the FX market, that same book would be quoted at 15.0000. All right? So the change in the 4th decimal point is called 1 pip. All right? And it's typically equal to 1/100th of 1%. Again, typically equal to 1/100th of 1%. All right. Now, I wanted to say something else. That's I'm tired. It's been a long day. I started doing a live stream at 5:30 in the morning for my programming channel. We're doing Python for finance and lots of fun stuff, but I'm really tired. I apologize. That's the beauty of being live, right? So among the major currencies, I think the only exception to that rule would be the Japanese yen. Yeah, the Japanese yen will be the only exception to that rule. All right, so that is question number 1 down. So I'll take a couple more questions before I wrap it up. I do have to travel tomorrow. I have a meeting in Boston. Some company wants to talk to me about some potential opportunities. So I'm going to go see what they have to say. So I do need to get going. I see we have another question. What are the current currencies? Okay, so the folks in the webinar, they're asking which currencies are traded in the foreign exchange market. So I can go through all of them. So the currencies that are traded in the foreign exchange market are euros, okay, all right, calm down. Sorry about that. Anyway, I always try to have fun with things, you know. I know this can be a little bit boring, so I try to keep, you know, good energy. But anyway, let's get serious. So the currencies that are traded in the foreign exchange market would be, so I'm going to give you the seven most liquid currency pairs in the world. Telemundo. I don't know, whatever. So you have euro, US dollars, right? And then you have US dollars and then the Japanese yen, that's JPY. And you have the pound, British pound, and US dollars. The pound is GBP, right? And then US dollars. And then you also have the US dollars and Swiss franc. So Swiss franc is going to be CHF. And then you also have 3 commodity. Okay, 3 commodity pairs, rather. You have 3 commodity pairs. You have the Australian dollar. You have Australian dollar, US dollar. That's the pair. Australian dollar, US dollar. So that's going to be AUD/USD. Then you have the Canadian dollar against the US dollar. So it's USD/CAD. That's US dollar, Canadian dollar. Then you have the so NZD, it sounds like a pill. Isn't there a show about some guy that takes these pills that makes him like super smart? Who knows what show that is? A guy, I think it's NZT. He takes these pills and it makes him like a genius, but then it wears out and he has to take it again and he solves these crimes and stuff. But anyway, it's not NZT, it's NZD is in Delta. That's New Zealand. So New Zealand, US dollar. NZD/USD. And I think I covered all 7. The 7 continents of the world, or rather the seven major currency pairs. So I believe we have one more question. And those of you guys that are listening in, appreciate that I've been up since 5:30 in the morning and now I'm doing a live stream late at night. Appreciate the hard work and dedication that goes into making these videos. I think this weekend alone, I must have put in easily like 15 hours. You know, it's a great expense to myself that I produce this content. And it is out of passion because, you know, I like my programming channel made like $6 last month. So for all the hours and hours I put in, you know, I got $6 back. So it's definitely a labor of love. I definitely don't do it for the money. And, you know, the way YouTube works, it really relies on you guys because YouTube wants to give you guys the best videos. How does it know the best videos? Based on what you do. So if you enjoy this video, you enjoy this type of content, make sure you like every video that I post. Like this video and every other video I post, unless it sucks, of course. And also share the video and comment. If you, at a minimum, even if you say hi, just say hi and that's it. You know, doesn't have to be a long conversation. Just say anything. But when I post a video and nobody comments or only a few people comment and most of you people don't like, that tells YouTube that the video sucks, and then the channel doesn't grow. And then why would I invest all this time trying to help out people when they're not even willing to do a simple thing like clicking on a like button or sharing or even just saying something? So comment as much as you can, like the video as much as you can. All right, so the final question before we shut down for the night. This is Carlisle Speaks Wall Street. This is our Understanding Foreign Exchange webinar. So what is this question? This question is a little complicated. I may not be able to answer this question. I'm being put on the spot here. So where some commissions? You want to know about commissions? Okay, so commissions. Let's talk about commissions. So where are the commissions in foreign exchange trading? You want to know where the commissions are. Obviously, with equities and other markets, there's typically commissions involved, right? Who's the one that I was using before? $7 commissions. Trade King. Shout out to Trade King. $7 commissions, I believe, last time I checked. Anyway, so that's the normal thing. But the FX market actually does not have commissions. So unlike the exchange-based markets, FX is considered a principles-only market. So FX firms are dealers, right? So FX firms are dealers. They're not brokers. Okay? I sound like, who talks like that? They're not brokers. They're not, I don't know, whatever. They're dealers, not brokers. So unlike brokers, dealers assume market risk by serving as a counterparty, right? So dealers are going to assume market risk by serving as a counterparty, all right? So old age is getting to me. Either old age or I'm tired. I'm losing my chain of thought. So they assume the market risk by serving as a counterparty to the investor's trade. And they do not charge commission. So there's no commissions being charged. Instead, what they're doing is they're making their money through the bid and the ask spread. You got the bid, you got the ask, and then you got in between, that's your spread. And that is how they make money, perhaps similar to a market maker. A market maker can make money that way as well by, profiting from the spread. But part of a market maker's responsibility is to maintain a healthy spread, right? There's a certain range where it's considered, don't quote me on that, healthy. That's just the word that I'm using. That's not like an official term. But there's a certain range in terms of what would be considered a good spread. It gets to a point where, maybe the spread is too wide or too thin, right? There's a certain sort of a green zone or hot spot, whatever you want to call it. But part of their job is to maintain that good spread, and that is where they make their profits. But in a foreign exchange market, it's the same kind of thing. So, or similar thing anyway. So every single penny gained is pure profit to the investor, right? Nevertheless, the fact that traders must always overcome the bid-ask spread makes scalping, not that kind of scalping, makes scalping much more difficult in foreign exchange. So I think that is all the questions we have for tonight. That's it. So thank you for joining in. This is Carlisle Speaks Wall Street across the globe. Buongiorno, buonanotte, buenas noches, and also wie geht's in Germany, Aleman. All right, guys, thanks for watching. Click on the like button, subscribe. Also, take a look at my programming videos that I'm working on right now. I'm going to be doing Python for finance. Right now, one of the projects I'm working on is doing a fixed engine simulator or trading simulator. I'm also pulling down real-time quotes, and I can show you how you can pull down real-time quotes yourself for free, right? Completely free. You can pull down real-time quotes. It's very, very easy. You guys know me. I make the complex very, very simple, right? Complex. I can't even speak now. I make complex topics very, very easy. That's why over 500,000 views on my SQL video. And one of my videos just went to 1.3 million views, and the tremendous feedback. It's just absolutely awesome. I want to give a shout out to some of my top subscribers and top supporters. I urge you to join my notification squad. Click on that bell icon. Shout out to Mega Noob, MJ Shahid. We also have someone listening in live while they're driving right now. What is it? Acosta DC is driving home right now. So shout out to you, and also to Dry Ice and all of my top subscribers. Really, really appreciate all the support from every single one of you. And I think that is it. Das ist it. What does he say? Akusa says, I will, like, oh, he says he's gonna like it when he gets home because he's driving. Finally caught it. Eric Wilson says he finally caught it. Yes, Eric Wilson, you finally caught the live foreign exchange webinar broadcast for free to you guys on YouTube. Well, not the whole thing. The webinar is definitely not free. If you guys want to join the webinar, you know, if you're really serious about foreign exchange, I definitely recommend that you join in on the webinar. I will work with you on price if that is an issue for you. Otherwise, I will continue to also produce content on YouTube for free for you guys. But obviously, this is kind of just the basics. If you really want to get the good stuff, book in the description, one of the top rated books. Also, the webinar. Also, there are classes. I'm going to sign up. I'm going to put a link as well in the description. Acosta DC, let Hanks Carlisle informative as always. I think you better not be texting while you're driving, buddy. All right, Eric Wilson and Costa and everybody else, to my notification squad. We're gonna sign out. What are we gonna sign out with? We gotta get some tunes to sign out to. Let's see. We got the finale. The ninth symphony by Beethoven. Oh yeah. Hit it.
Options are just like coupons.
Sir, Unit Bravo Alpha Delta Nate.
I have two great reasons why you should subscribe to this channel right now. What is the bid price? Number one, because you want to learn all about trading and trading technology and not fall asleep and not get a headache. My videos make you smile and make you finally understand complex topics like no other. Number two, because rather than listen to me self-promote, you're going to take a look at what some of my viewers are saying about my videos. Don't take my word for it. The proof is in the pudding or the comments.
So the fact that you're still watching this video, obviously you enjoyed it. That's very, very clear. And I applaud your efforts for taking the time to watch this video and try to learn something new. You're probably watching other free videos and websites and things like that. But I really, really urge you to take things a little bit more seriously. Not discount the information you've acquired through those methods, but really, really, really what you really want to do, click on the link in the description. Take my full course. This is Carlisle Speaks Wall Street signing off.